$10.4 billion. I really want you to hold that number in your head for a second.
It's a massive figure.
Right, $10.4 billion. I mean, if we were talking about the GDP of like a small island nation, that would be a completely respectable figure. But we are looking at the fiscal year 2026 gross bookings for literally one single travel company, and that's MakeMyTrip.
Yeah, and it really forces a complete recalibration of how we view emerging market consumer scale. Because when a regional online travel agency crosses that $10 billion threshold, it stops being just a corporate success story. It actually becomes a macroeconomic indicator.
Absolutely. Welcome to the deep dive. Today, we are tearing into the source material from MakeMyTrip's Q4 2026 earnings conference call. And, the reason we're doing this isn't just to talk about plane tickets or hotel rooms. This breakdown is really a masterclass in survival and scale.
It really is. It's fascinating.
We are looking at a company that is riding like the largest demographic wave on the planet, which is this booming Indian middle class, while simultaneously getting slammed by geopolitical crises that literally grounded international flights. So whether you are an investor trying to spot the next massive growth engine, or maybe a developer curious about how generative AI is actually deployed at an enterprise scale, or, just someone trying to understand where the global economy is heading, the mechanics of how MakeMyTrip navigated this quarter are just incredible.
Yeah, and I think the raw volume of travel they processed could easily be misread, to be honest.
How so?
Well, a casual observer might look at that $10.4 billion and just write it off as, the final dying gasp of post-COVID revenge travel.
Oh, right. Like everyone just getting it out of their system.
Exactly. But the internal data they presented paints a completely different picture. Revenge travel is dead. It's over. What we are seeing now is the concrete foundation of a multi-decade structural shift in consumer behavior. The baseline has permanently moved.
Okay, yeah. And you really cannot jump straight into the chaos of their fourth quarter without understanding that new baseline. You have to look at the bedrock first. The call highlighted that their gross bookings grew from $3.2 billion in fiscal year 22 to $6.6 billion in fiscal year 23, all the way to this record $10.4 billion today.
Which is just wild growth.
It is. That is a 34% compound annual growth rate over 4 years. To maintain a 34% growth rate at that massive scale, something fundamental in the society has to change, right?
Yeah, absolutely. And the management team actually provided the specific mechanism driving that scale. They cited this recent Bain study on the Indian demographic dividend.
Right, the Bain study. Let's unpack that.
So they zeroed in on households earning between $4,500 and $35,000 annually. And, in the context of the Indian economy, taking into account purchasing power parity, this specific income bracket is the absolute engine of discretionary spending.
That's the sweet spot.
Exactly. And the study projects this demographic to jump from 200 million households in 2022 to 300 million by 2032.
Adding 100 million households to the consumer class in a single decade. Think about that. That is essentially handing disposable income to a population the size of the entire United States.
It's staggering.
And the ultimate physical proof of that new disposable income is the passport. The management noted that India added over 70 million new passport holders in just the last 5 years.
Yeah, and you have to realize a passport in an emerging market is far more than just a travel document. It's really a psychological threshold.
What do you mean by that?
Well, it signifies this transition from, securing basic survival needs to actively seeking outward experiences. The aspiration to engage with the broader world has literally been formalized into a government document for 70 million people who previously never even considered leaving the country.
Okay, but I do have to push back on that a little bit, though, because, a passport is valid for 10 years. Just because a household enters that $10,000 a year income bracket and gets a little blue book doesn't mean they are suddenly jet-setting to Paris every weekend.
Right, that's a fair point.
So my question is, how does this actually translate into frequency? Is this still just the traditional model where a family saves up for like 3 years to take one massive, highly stressful holiday?
No, and that's the key. The underlying behavior itself has fundamentally mutated. Travel in this demographic has transitioned from an occasion to a habit.
From occasion to habit. I like that.
Yeah, the company actually referenced research showing that Indian millennials are now taking 3 to 6 trips a year.
Wow, up to 6 trips.
Exactly. The massive annual holiday is being fragmented into shorter, highly frequent bursts. So maybe it's a religious trip with parents, a long weekend getaway with friends, and then perhaps one international trip.
And The wallet share dedicated to this habit is what really caught my attention in the call. They noted that Indian millennials are now spending an average of $6,000 annually on travel.
Which is huge for that demographic.
It's insane. That consumes 34% of their discretionary spending. It is their single largest non-essential expense. And if you think about the life stage of a millennial, I mean, they haven't even hit their peak earning years yet.
Exactly.
The amount of capital they are willing to deploy per trip is only going to scale upward as they age into, senior management roles and things like that.
But there's a massive bottleneck here that we have to talk about.
Yeah.
Because you can hand 300 million households passports, and you can give them newly minted disposable income. But if there is literally no tarmac to land the planes on, that demand simply evaporates.
Right. It's just pent-up frustration.
Exactly. It becomes unmonetizable frustration.
Yeah.
You cannot have a travel boom without an aggressive, almost militant expansion of physical infrastructure.
And the infrastructure build-out they detailed on the call feels almost fictional. I mean, the numbers are wild. The number of operational airports in India doubled from 74 in 2014 to 157 in 2024.
More than double.
Yeah, and their target is 400 airports by 2047. On top of that, the national highway network expanded from around 91,000 kilometers to over 146,000 kilometers. At their peak, they were laying down 34 kilometers of new highway every single day.
And mechanically, you have to think about what that means. Every single new airport acts as a localized economic detonator.
That's a great way to put it.
Because it instantly creates a brand new addressable market for an online travel agency. When a new direct flight opens from a Tier 2 city to Dubai or Singapore, MakeMyTrip doesn't just sell that flight.
Right, they sell the whole package.
Exactly. They sell the connecting hotel, the visa processing, the travel insurance, the local experiences. Furthermore, expanding the highway network isn't just about moving freight. It radically compresses travel time.
Which makes weekend trips actually viable.
Exactly. It unlocks the very concept of the weekend getaway for millions of people who previously lived 8 or 10 grueling hours away from a leisure destination. Now it's a smooth 3-hour drive.
But having a paved road and a shiny new airport terminal is only really half the equation. Think about the friction of actually booking that trip 10 years ago.
Oh, it was awful.
Right. You had to physically walk into a local travel agent's office, sit across a desk, look through a laminated brochure, and hand over a stack of physical cash. That kind of friction actively suppresses demand. And this is where the digital infrastructure completely cleared out the pipes.
The digital side is the real unsung hero here.
Totally. We are looking at an internet penetration nearing 1 billion people, fueled by data costs that plummeted from 269 rupees per gigabyte down to just 9 rupees.
Yeah, the cheap data is the entry ticket. But the true catalyst, the thing that makes it all work, is the payment layer. The Unified Payments Interface, or UPI, is the mechanism that removed the final barrier to scale. The call noted that UPI is clearing over 16 billion transactions a month.
16 billion a month. For anyone listening who isn't super familiar with UPI, think of it as a state-backed digital public good. It allows your bank account to talk directly to a merchant's bank account instantly on your phone with 0 transaction fees.
No middleman.
Exactly. No Visa or MasterCard middleman taking a 3% cut. You just scan a QR code or enter a virtual ID and the money moves. Boom. Done.
And when you combine virtually free 4G data with an instant, frictionless payment network that requires 0 credit card penetration, you effectively eradicate checkout abandonment.
Which is huge for an e-commerce platform.
Huge. Globally, the friction of entering credit card details or facing payment gateway failures or waiting for a one-time password that has been the bane of e-commerce.
Yep.
By utilizing UPI, a traveler in a smaller Tier 3 city can search for a flight, compare prices, select a seat, and finalize the payment in under 3 minutes, entirely on a budget Android smartphone.
And the geographic shift here is critical for investors to understand. The management team heavily emphasized that Tier 2 and Tier 3 cities are the new engines of growth.
It's not just Mumbai and Delhi anymore.
Right. A consumer living in Indore or Coimbatore or Jaipur now has the exact same digital access and increasingly the exact same purchasing power as someone living in the wealthy enclaves of the massive metros. The total addressable market didn't just grow, it geographically decentralized.
It's spread out. And having established this incredible baseline, a rising middle class, newly built airports, and frictionless digital payments, we have to look at how this machine performs under severe stress.
Because it wasn't all sunshine and roses.
Not at all. because the operating environment in the fourth quarter of fiscal 2026 was anything but a smooth upward trajectory. They ran directly into a major geopolitical crisis.
Yeah, the conflict in West Asia, it started dominating the global headlines. But on this earnings call, we actually get to see the financial mechanics of how a war thousands of miles away bleeds directly into the quarterly earnings of an Indian travel company.
Yeah, the initial impact in March was largely behavioral. As tensions in the Middle East escalated, consumer sentiment just plummeted.
People were scared to fly.
Right. Travelers were canceling flights, and airlines were preemptively suspending routes through the affected airspace. But as the conflict persisted, it evolved from a disruption of physical routes into a severe inflationary crisis.
It acted like a sudden pressure valve release on the global energy markets. The conflict choked off supply line confidence, which spiked the cost of crude oil. And because emerging markets are so incredibly sensitive to global energy pricing, this simultaneously drove a depreciation of the Indian rupee.
And that's the double whammy. When an airline is suddenly paying significantly more for jet fuel, and they are paying for it with a weakened currency, they have absolutely no choice but to pass that cost directly on to the consumer.
The margins are too thin otherwise.
Exactly. So airfares, both domestic and international, spiked aggressively.
And the Indian consumer is highly price elastic. If the flight to London or Dubai suddenly costs 40% more, they don't just, put it on a credit card and figure it out later like an American consumer might.
No, they cancel the trip entirely.
Right. The data they reported was brutal. International passenger traffic declined by 6% year over year in the quarter. Even domestic flown passengers dropped by 1.5%. So if your core revenue driver, which is booking flights, is shrinking, how do you report a record $10.4 billion year? Like, how do you even survive that?
You survive it through ruthless corporate agility and a highly diversified product portfolio.
Okay, break that down.
Well, MakeMyTrip did not attempt to fight the macroeconomic reality. When westbound international travel stalled and airfares became prohibitively expensive, they immediately recalibrated their algorithms and their marketing spend.
They shifted focus.
Exactly. They began relentlessly pushing eastbound international travel. Destinations in Southeast Asia like Vietnam, Thailand, and Indonesia, where airspace wasn't constrained, and regional carriers are offering much more manageable fares.
Can't afford to fly west. Let us show you the beautiful beaches in the East. It's smart. But honestly, their pivot on the domestic front is what really blew my mind.
The ground transport pivot.
Yes. They leaned incredibly hard into ground transport. If a domestic flight from Delhi to Manali suddenly cost way too much, they made sure they captured that intent before the user closed the app in frustration. They reported that their bus ticketing volumes surged by 27.6% year over year.
And the mechanics of that bus pivot are just a huge testament to their supply-side integration.
How so?
Because the Indian intercity bus market has historically been incredibly fragmented. I mean, it's run by thousands of independent localized operators using paper ledgers and clipboards. MakeMyTrip spent years digitizing this inventory, and during this specific quarter, they scaled their available private bus inventory to an astonishing 46,000 daily schedules.
But wait, how does a tech platform dynamically scale physical buses, though? I mean, they don't actually own the vehicles, right?
No, they don't own the buses, they own the data. They revamped the route suggestion algorithms for their bus operator partners. So when MakeMyTrip's backend sees a massive surge of users searching for flights on a specific route, balking at the high prices, and abandoning their carts, the algorithm aggregates that unmet demand.
It sees the intent.
Exactly. It then sends a signal to the private bus operators on that specific route, indicating a high probability of guaranteed bookings if they deploy additional vehicles immediately.
That is wild. They are essentially acting as a real-time air traffic controller for ground transport. And it didn't even stop at buses. Their intercity cab segment grew over 20%.
They ensured that the consumer's travel budget wasn't destroyed by the geopolitical shock. It was merely reallocated to a different mode of transport within the MakeMyTrip ecosystem.
And they also reallocated the type of trips consumers were taking, right? Management highlighted a massive surge in what they call pilgrimage plus pleasure trips.
Yeah, that's a fascinating trend.
I love this concept. Spiritual tourism in India is undergoing a massive renaissance right now. People aren't just going to a temple for an afternoon and going home. They are booking a trip to a major spiritual center like Ayodhya or Varanasi, performing their religious duties, and then extending the trip into a 3-day leisure holiday in the surrounding region.
And the physical infrastructure is following this trend very closely. The leadership pointed out that 70,000 new hotel keys are projected to be added to India's hotel sector by 2030.
70,000.
Yeah, and a disproportionately large percentage of those new builds are targeting undersupplied Tier 2 markets and these rapidly emerging spiritual corridors. The motivation for travel is becoming deeply cultural and experiential, which makes it highly resilient to economic shocks.
And this pivot into alternative transport and regional spiritual tourism is exactly why their accommodation business thrived while the airlines suffered.
Right, because everyone still needs a bed.
Exactly. Think about it. Whether you fly, take an air-conditioned sleeper bus, or rent an inner-city cab, you still need a place to sleep when you finally arrive. While the broader Indian hotel industry saw occupancy rates remain flat or even dip slightly during the quarter, MakeMyTrip's accommodation segment grew by 15.2% year over year.
That's a huge divergence from the industry average.
It really is. They even recorded their highest ever domestic hotel check-ins over the January 24th long weekend. They crossed 200,000 room nights in a single day.
Which proves they successfully captured the demand that was priced out of the sky, brought it down to the ground, and redirected it into regional hotels and boutique homestays. It is a textbook demonstration of why being a multimodal platform is a vital defense mechanism against external shocks.
Okay, so we've seen how they use buses and homestays to survive a geopolitical crisis, but surviving the present isn't the same as owning the future.
No, it's not.
To understand where MakeMyTrip is going next, we have to look at how they are completely rewiring their software infrastructure, because they are aggressively attempting to build what they call an AI-native organization.
Yeah, and the transition from discussing physical highways to neural networks is jarring, I admit, but it is the core of their future strategy. Management made it very clear that they view generative AI not merely as a back-end productivity tool or, a customer service novelty.
Right, not just a chat bot bolted onto the website.
Exactly. They see it as a foundational computational layer. They intend for AI to redefine the entire life cycle of a traveler's journey, from initial discovery and complex planning to the actual booking and post-sale servicing.
And enter Myra. Myra is their Gen AI assistant, and honestly, calling it a chatbot feels entirely inadequate based on the metrics they shared. Myra is a full-funnel travel companion handling over 80,000 conversations every single day.
80,000 daily.
Yeah. And it's not just spitting out FAQ articles about baggage allowances. Myra can actually process end-to-end itinerary planning and even execute the final payment, heavily utilizing multilingual voice features.
And the demographic breakdown of who is actually talking to Myra is perhaps the most counterintuitive piece of data in the entire earnings call.
Oh, this part blew my mind.
Right. Because the traditional assumption in tech is that early adoption of complex AI features is restricted to affluent, highly educated users in major metropolitan hubs like Bangalore or Mumbai.
The early adopters.
Exactly. But the data reveals the exact opposite. 45% of Myra's usage is originating from Tier 2 and smaller cities.
Almost half.
Yes. Furthermore, voice interactions are 50% higher in these non-metro markets compared to the large urban centers.
This is where human behavioral psychology perfectly meets technology. Because you might assume that a user in a Tier 3 city using voice commands is asking very basic, simple questions like, find a flight to Goa. But the call highlighted that prompts using English voice are actually 40% longer and vastly more complex than typed text inputs.
And the mechanism behind this is the reduction of digital friction. For millions of consumers who are newly entering the digital economy, typing a complex query on a small glass smartphone keyboard is a highly frustrating, high-friction activity.
Oh, absolutely, especially if English isn't your first language.
Exactly. If English is their second or third language, typing is a barrier. Voice AI bypasses that physical friction entirely.
Exactly. When a user speaks to Myra, they don't use rigid robotic search terms. They speak in paragraphs. They say, I need a flight to Goa next Friday, arriving before noon, and I need a hotel near the beach that has a kids' pool, and make sure it includes a breakfast buffet.
Which is incredible context.
Right. That isn't just a search query. That is massive, highly specific user intent. By removing the keyboard, MakeMyTrip is capturing the full scope of what the user actually wants. And to capitalize on this, they recently expanded Myra's capabilities into 7 additional regional languages.
And capturing that deep intent translates directly into measurable financial impact. The ROI on this AI integration is already totally visible.
Give me numbers.
Users who interact with Myra exhibit a 10% higher conversion rate compared to users who rely on traditional drop-down menus and manual filters. In this conflict-impacted quarter alone, Myra directly assisted with over 200,000 final bookings.
That's real revenue being driven by a voice model. And they also discussed a feature called Smart Search, which completely changes the underlying mechanics of how we find hotels in the first place.
Yeah, Smart Search is brilliant.
If you think about traditional hotel search, it relies entirely on rigid keyword matching. If you want a hotel with a rooftop pool, you type rooftop pool, and the system scans its database to see if the hotel manager manually checked the rooftop pool tag when they built their profile.
And if they forgot to check the box.
If a hotel doesn't show up, it's invisible.
Right. But Smart Search utilizes large language models, or LLMs, to process semantic search. An LLM doesn't look for exact keyword matches. It understands the conceptual relationship between words.
It understands meaning.
Yes. The management gave the example of a user searching for a family stay near Baga Beach with Jain food, or a rooftop pool hotel in Jaipur with spa access. The AI analyzes vast troves of unstructured data, like thousands of written user reviews, photo descriptions, and local travel blogs to understand the context of the query.
That is so cool.
It delivers precise, explainable results based on the actual reality of the hotel, not just its rigid metadata tags.
It's literally the difference between a filing cabinet and a human concierge. But the AI transformation isn't just happening on the front end with the customer. The internal operational efficiencies they mentioned are staggering. They reported that 60 to 70% of MakeMyTrip's new code is now being written by AI tools.
Though we must be precise about what that means mechanically. They're not allowing an autonomous AI to just push untested software directly to their live servers.
God, no. That would be terrifying.
It would be a disaster. What they're doing is utilizing enterprise-grade AI coding assistants as force multipliers for their human engineers. The AI writes the tedious boilerplate code, handles the routine API integrations, and spots syntax errors in real time.
It does the grunt work.
Exactly, which allows the human developers to focus entirely on complex system architecture and unique feature development.
It radically accelerates their deployment cycles.
Yeah.
And on the customer support side, 55% of all call center queries regarding flights and hotels are now being completely resolved by digital voice agents.
Over half.
Yeah. More than half the time, a customer calls in with a problem, speaks to an AI, gets their issue fixed, and hangs up without a human employee ever getting involved.
And those operational efficiencies represent a massive lever for future margin expansion. However, this aggressive embrace of generative AI inevitably leads to a pretty existential question for the company.
The moat question.
Yes. An analyst during the Q&A portion of the call directly challenged the management on this. They asked, as generic LLMs like ChatGPT or Google's Gemini became increasingly sophisticated, what prevents them from simply bypassing MakeMyTrip altogether?
Which is the nightmare scenario for literally any platform company. It's called agentic commerce. If I can just open the ChatGPT app, give it access to my credit card and say, hey, plan a family vacation to Kerala and book everything, why do I need to download the MakeMyTrip app? Why do I need an online travel agency at all?
And the CEO provided a remarkably detailed defense of their business model against this exact threat. He outlined 4 specific structural moats that are incredibly difficult for a horizontal generalized AI to replicate.
Okay, let's go through them. What's the first moat?
The first moat is their highly fragmented supply side. Booking a standardized flight from Delhi to Mumbai is a simple API call. An AI can do that easily. But MakeMyTrip has spent nearly 2 decades doing the grueling, offline operational work of onboarding tens of thousands of fragmented, independent boutique hotels, rural homestays, and regional bus operators.
Right. A language model can generate a beautiful, poetic itinerary about a hidden homestay in the mountains. But it cannot physically digitize that homestay's paper ledger or force the owner to honor a booking. It requires ground-level, human operational infrastructure.
Precisely. The second moat is deep post-sale fulfillment.
The customer service reality.
Yes. It is one thing for an AI to seamlessly book a trip when everything goes perfectly. It is an entirely different operational reality to handle the chaos of travel disruptions. When a user is standing in a hotel lobby at 2 a.m. in a foreign country, discovering their room was double booked, They do not want to argue with a generic chatbot.
Oh, I would lose my mind.
Right. They need real-time, deep funnel conflict resolution that connects directly to the hotel's localized inventory management system. General AI models are simply not equipped for edge case, physical world customer service.
Makes sense. Okay, what's the third moat?
The third moat is all about the money. Deep payment integrations. We talked about how magical UPI is, but integrating it commercially is complex.
It's not just plug and play.
No. MakeMyTrip has built customized commercial alignments with dozens of local banks. They offer localized promotional discounts, and they handle the messy reality of multi-currency refunds. A global AI platform built in Silicon Valley is going to struggle immensely to emulate that highly localized financial plumbing.
Yeah, the localized banking relationships take years to build. And the fourth moat,
the final moat the CEO highlighted is the complex technical challenge of coupling and decoupling extensive services.
What does that mean in practice?
Well, think about it. A user's travel itinerary is a living, breathing entity. They might book a flight, a bus, 2 different hotels, and an intercity cab as a single transaction.
Okay.
If they later need to cancel just the bus portion, modify the cab pickup time, and upgrade the hotel room. The back-end engineering required to seamlessly decouple those services, recalculate the localized taxes, issue a partial refund via UPI, and instantly confirm the new bookings is incredibly specialized.
Oh, I see.
Management firmly believes that while generalized AI will undoubtedly dominate the discovery and planning phase of travel, it lacks the operational DNA to penetrate the messy physical reality of the transactional funnel.
So the strategy is essentially let ChatGPT give the user a great idea for a vacation, but when the flight gets delayed and they need a partial refund issued back to their local bank account while rebooking a sleeper bus in a regional dialect, they are going to need MakeMyTrip.
Exactly.
It is a powerful argument.
It is. But you build these AI moats to protect the future, and you scale your bus network to survive the geopolitical crises of the present. But the ultimate reality check for any corporate strategy is whether those operational pivots actually protect the bottom line.
The money. Let's look at the financial execution, because the numbers here are the ultimate scorecard for retail investors.
Always.
For the full fiscal year 2026, despite all the headwinds we've discussed, their revenue grew by 10.7% year over year in constant currency. But revenue is just top-line vanity, right?
Right.
The really impressive figure is their profitability. Their adjusted operating profit, commonly referred to as EBIT earnings, before interest and taxes hit $156 million. That is a massive 30.1% year-over-year growth.
And to understand how a company grows its operating profit by 30% during a quarter when its core product, international flights, is experiencing negative growth, we have to look at operating leverage.
Break that down. How does operating leverage actually work in this specific scenario?
Well, operating leverage essentially measures how well a company can increase its revenue without proportionally increasing its fixed costs. When MakeMyTrip pivoted the consumer away from low-margin airline tickets and toward higher-margin domestic accommodation and customized alternative transport, they drastically improved their unit economics.
They sold more profitable stuff.
Yes. Combine that high-margin product mix with the internal AI efficiencies we discussed, like resolving 55% of customer queries without paying human call center agents, and you create massive leverage. Their adjusted operating profit margin expanded to 1.82% of gross bookings, up from 1.71% the previous year.
Expanding your profit margins while navigating an international geopolitical conflict is, it's the definition of a resilient business model. And it throws off a staggering amount of cash.
Oh, the cash generation is wild.
They generated $182.5 million in operating cash flow for the year. That means they converted an unbelievable 97% of their adjusted operating profit directly into hard cash.
And when a business model proves it can generate unencumbered cash flow at that scale, capital allocation becomes a management team's most critical responsibility.
Right. What do they do with all that money?
Exactly. How do they deploy that cash to signal confidence and secure future growth? First, they executed a $100 million share buyback program.
And for the listener, a share buyback is exactly what it sounds like. The company uses its own cash to buy its shares back from the open market and retire them.
It shrinks the supply.
Right. It reduces the total number of shares in existence, which makes every remaining share more valuable. It is management's way of telling the market, hey, we believe our stock is deeply undervalued, and we are willing to spend $100 million of our own cash to prove it.
And they utilized $96.4 million of that authorization within the year, which the CFO noted was the highest single-year buyback they have ever executed.
Wow.
But even after that massive capital return to shareholders, they ended the quarter with over $782 million in cash and cash equivalents.
A $782 million war chest gives a company terrifying optionality. You don't just survive downturns with that kind of money. You go on the offensive. You buy your way into new avenues of growth. And we saw them do exactly that through targeted M&A mergers and acquisitions.
Yeah, the acquisitions they discussed on the call were highly strategic, specifically designed to plug gaps in their ecosystem.
Like Flamingo.
Yes. They acquired a majority stake in a company called Flamingo. Now, Flamingo is not a broad, generalized travel agency. They are a highly specialized regional group holiday packager based out of the state of Gujarat. They completely dominate the market in surrounding states like Maharashtra, Rajasthan, and Madhya Pradesh.
But why buy a regional packager when you are a massive national tech platform? Like, why bother?
Because Flamingo specializes in highly customized, culturally specific experiences, specifically vegetarian-friendly international tours for large family groups.
That is incredibly specific.
It is. Building the operational capability to guarantee high-quality, pure vegetarian Indian cuisine for a 30-person family group traveling through rural Europe is incredibly complex.
I can imagine.
By acquiring Flamingo, MakeMyTrip instantly captures a highly lucrative, deeply loyal demographic niche that generic platforms simply cannot serve.
That's brilliant. And they also took a minority stake in a company called Atlas, which is a visa processing platform.
Which is such a smart play.
If we go back to our earlier discussion about the rusty pipe of emerging market travel, obtaining a visa is historically the single most frustrating, opaque, and anxiety-inducing part of traveling abroad for an Indian citizen.
It's a nightmare. The paperwork is endless.
Exactly. By integrating Atlas's technology into their platform, MakeMyTrip is attempting to smooth out that process. And it isn't just about making the user happy. If you control the visa process, you know exactly when the user is approved.
Which is the perfect cross-sell opportunity.
Boom. It creates the perfect moment to cross-sell travel insurance, international SIM cards, and foreign exchange services.
It is the systematic construction of an end-to-end travel ecosystem. But before we wrap up the financial and strategic analysis, we really have to address a major structural tease that management dropped at the very end of the call.
Oh, right. It immediately dominated the analyst Q&A session.
The company announced they are undergoing an internal corporate restructuring, exploring a potential listing in the Indian capital markets.
The coming home narrative. For context, MakeMyTrip is an Indian company serving the Indian consumer, but it is currently listed on a U.S. stock exchange via a holding entity based in Mauritius. An analyst asked them to explain the timeline and mechanics of unwinding that, because moving a multi-billion-dollar publicly traded entity across global jurisdictions sounds like a literal nightmare.
It is a phenomenal legal, tax, and governance puzzle.
A total headache.
Oh, yeah. The management was very careful to temper expectations, explicitly stating that this is a long-term, multi-step strategic priority, not something happening next quarter. But the fundamental rationale makes perfect sense.
Why are they doing it?
Well, their primary revenue, their operational workforce, their brand equity, and their core addressable market are all situated in India. Listing on the Indian stock exchanges aligns their capital structure with their operational reality.
It just makes logical sense.
Right. It allows domestic Indian mutual funds and retail investors, the very people driving their $10.4 billion in bookings, to actually own a piece of the company.
So why not just fill out some paperwork and list the shares in Mumbai tomorrow?
Because of the complex regulatory landscape. The Indian government currently does not allow for the type of dual listing MakeMyTrip would require. You cannot simply have the exact same shares trading simultaneously in New York and Mumbai under their current corporate structure.
Okay, so how do they actually pull it off then?
As the leadership explained, it will likely necessitate a prolonged transitional period involving multiple listed entities operating within a broader, newly created group structure.
Sounds expensive.
Very. But over the long term, the ultimate goal is to consolidate this into a singular, fungible structure. In corporate equity terms, fungible means the shares are mutually interchangeable regardless of where they are traded. But achieving that seamless integration across U.S. and Indian tax and regulatory regimes will take years of careful maneuvering.
It is going to be a fascinating corporate subplot to watch over the next few years as they try to unspool that structure.
Yeah, it is the ultimate reflection of an emerging market company maturing into a truly global powerhouse.
We have covered a massive expanse of territory today. I mean, we started by looking at a staggering $10.4 billion gross booking number. We traced that explosion in demand all the way back to the structural, quiet rise of a 300 million strong middle class, armed with new passports and frictionless digital payment networks like UPI.
Right.
We examine the mechanical reality of how a company survives a geopolitical shock by acting as a real-time air traffic controller, instantly pivoting consumer demand from hyperinflated airline tickets to a digitized network of 46,000 intercity buses and regional spiritual tourism.
The agility was incredible.
And finally, we explored how they are aggressively rewriting their core operational DNA, utilizing generative AI not just to write code, but to capture complex human intent through regional voice commands while building deep operational moats to fend off the tech giants.
It is an unparalleled case study in the synchronization of demographic scale, physical infrastructure, and bleeding-edge technology.
And if you are listening to this right now, this deep dive matters because the playbook we just outlined isn't confined to the travel industry. If you are an investor building a thesis on emerging markets, you are seeing the direct financial result of what happens when massive consumer aspiration finally meets functioning infrastructure.
Exactly.
If you are a founder or an executive trying to navigate global volatility, you are looking at a masterclass in platform resilience. MakeMyTrip didn't just rely on theoretical, high-tech AI solutions to save their quarter. They combined that AI with something as deeply physical and unglamorous as deploying air-conditioned sleeper buses to the foothills of the Himalayas.
They bridged the digital and the physical.
They survived because they met the customer exactly where their intent and their wallet actually lived.
And if we pull all of these disparate threads together, the rising middle class, the frictionless payments, and the AI transformation, I would like to leave you with one final thought to consider.
Let's hear it.
We discussed how Myra, their Gen AI voice assistant, is experiencing its highest engagement and most complex prompts from users in Tier 2 and Tier 3 cities. Voice technology is actively bypassing the literacy, language, and physical friction barriers for millions of newly middle-class consumers who find typing on a smartphone cumbersome.
It completely flips the traditional tech adoption curve on its head.
It does. Consider the profound long-term implications of that behavioral shift. Could the next great wave of global economic consumption be driven entirely by people who never touch a keyboard?
Wow.
If a traveler in a rural region can simply speak a fluid conversational prompt in their native dialect into a cheap smartphone, instantly organizing a multi-city international itinerary, complete with customized vegetarian meals, specialized ground transport, and specific hotel amenities, how will the broader global economy adapt?
That's a huge question.
We are rapidly approaching a reality where the largest, most lucrative new customer base on the planet interacts with commerce entirely by speaking to algorithms. The organizations that can build the infrastructure to listen to that voice, understand its nuanced intent, and flawlessly execute the fulfillment in the messy physical world. Well, those are the companies that will own the next decade.
We aren't just looking at a travel company adjusting to a volatile quarter. We are watching the tectonic mechanics of human consumption being fundamentally rewired in real time. Until next time, keep diving deep.